I want to kind of just dig into this because this is subject matter that we haven't really ever at all dug into on the podcast. And I mean, obviously, there's thousands and thousands of retail car dealerships out there. There's some large dealer groups. There's some single rooftop stores. You guys have the vantage point because you're able to provide accounting and bookkeeping and auditing and all of those sorts of things for many dealerships. So I want to turn this over to you. What, from your vantage point, from your experience, what are maybe some of the common challenges that dealerships face when it comes to their money and their finances?
Well, there's three top things. The first thing is the efficiency of the accounting department is very important no matter your size. We have clients that range from single rooftops to multi-store groups that have several brands, several stores, sometimes several stores of the same brand. So we run the gamut between large dealership groups and smaller groups, and all of them have similar concerns with how the accounting is processed and really knowing where the finances of a dealership stand at any point in time, and the interplay between what is known in the industry as the back office and the front line sales and F&I and service and parts, and how the accounting department is really a service department to the rest of the dealership, and how it many times is an untapped tool to the owners of these dealerships, because the accounting function can really serve more than just processing deals and processing title work and spitting out a dealer statement at the end of the month. So a lot of the challenges revolve around how fast can I get my numbers, how efficient is my accounting department in turning around the paperwork to process title work for our customers so they get their title work done quickly. So there are a lot of things that go into the back office, and the back office, it serves as such a crucial function that it cannot be neglected. So deal processing, we are seeing the change to electronic deal processing. And that's one of the things that we're encouraging our dealers to do, because the bottlenecks that typically occur have to do with paperwork. And a lot of it the technology is out there that can basically make your life, the back office, and also your frontline F&I, your sales department, be more efficient with e-contracting. So there's a lot of technology. So those are some of those areas relating to efficiencies are important. Obviously, dealerships want to be able to save money on taxes. That's always top of mind.
Right.
And I have some ideas regarding that I can go into. And the other thing that we get called a lot about is the risk of fraud by employees at dealerships. It's something that it goes hand in hand with having efficiencies in your accounting department, and it goes hand in hand with the oversight of your numbers and how your dealership is doing. So all those things interplay, and a well-run back office will make you be more successful. It's one of the messages that I always try to drive home. It cannot be neglected. It's something that you have to be on top of how your back office is functioning and working, more importantly, not just how they function, not in a vacuum, but together with the rest of the dealership.
Yeah, this is really interesting to me, especially from the perspective of, though it's back office, there are some very real implications on the front end process, like how efficient can we actually become? How many, despite there being a miscellany of moving pieces that we always kind of use as a scapegoat, there is the narrative out there like, hey, customers want this process to be faster. And so I love what you're saying, like, hey, if we can strengthen back-end processes, if we can make them more efficient, if we can get a hold of certain things like digital processing, which I want to ask you about in just a second, then maybe, just maybe, this will contribute to improving all processes dealership wide. So
That's correct.
In terms of digital processing, I mean, obviously then the dealer is going to have to pay for a service that's going to help them do these things. From your experience, does the cost or monthly investment of a service like that justify, like, are they able to make it up on the back end?
Well, certainly. So a lot of the bigger and the typical accounting software packages that are out there, the big players are CDK, which is formerly known as ADP, and Reynolds and Reynolds. There are others that are very good that are coming up in the ranks, DealerTrack among them, and several others. But all of these DMS systems, dealership management systems, which in the IT industry they're known also as ERP systems,
Sure.
because they handle all aspects of the accounting and processing. They process your repair orders in the service department. They'll process your deals. So all of these softwares packages handle all the accounting, all the transactions in your dealership, and more they are moving towards electronic documents, and a lot of them are offering that. There is additional cost for storage, for example, for deals. So let me talk a little bit about specifically something that's always a pain point with dealerships, especially when they're trying to close faster and get results faster. And it's always a pain point between the sales and F&I and the back office. So a lot of the problems that occur that I see typical in a typical process to try to close a month is paperwork that's missing in your deal folders. So the typical dealership has these deal folders, maybe different colors, a different color for used cars and a different color for new cars for different brands. And those, you have to make sure you have a checklist that has all the compliance, because obviously dealerships, people many times don't realize, have a lot of legal requirements to meet. Everything from odometer disclosures to other F&I disclosures that are required by law. So all of those documents have to be in, but many times the holdup is on key documents such as title work and documentation needed for the financing financing the customer. So those things are now, when they're tracked electronically, it's much easier. Also avoids double data entry. So you're entering, information in the F&I screen, it automatically pre-populates in the accounting. So then when the accounting clerk goes to post the deal, data doesn't have to re-enter. You don't have to re-enter the deal number and all the other transactional
Sure.
details, the trade-in value, all the different things.
Right.
Don't have to re-enter. So that alone, just in efficiencies, in your people efficiencies, that alone will help pay for it. And the time, it's one of those intangibles that it's hard to put a number on, but the mere amount of time that's saved is substantial. And the filing costs, right now, most dealerships have tons of paper that they save. A lot of this now is electronic, scanned, and then you're saving on physical storage because you only hold them for a short period of time, then they're scanned, and the physical documents disappear. So while there's some costs involved, there are other soft costs and actual costs that will be, savings that will help offset the additional costs of going through technology.
Yeah. What's interesting about this, I mean, you had just touched on something that I am so incredibly passionate about, and it is the intangible, yet very tangible, if you really dig into it, concept of what the cost truly is. I mean, so many are focused simply on what they can see on a P&L or a profit and loss, but they're not really focused on what the implications are of certain what they think are fixed costs. And it's kind of this economy thing. Like, look at today. I mean, very real today. Look at what's happening with the markets, and they're all tanking, and people are panicking, and they're not sure what's causing this and that, and there's speculation and there's conspiracies and all these sorts of things, and people are panicking. I submit that people should be having this same level of panic for not keeping track of the internal economy of the store by simply suggesting that, hey, Employee A, let's call him Mike. See how original I am? I go for the most common name in the name book. So Mike gets paid $40,000 a year. That $40,000 a year goes onto the P&L, and the owner or the controller or the accountant or everybody go, great. Mike costs $40,000 a year. But then all of a sudden it's like, yeah, but who's keeping track of how much productivity gets put inside of that $40,000 a year? Like, what is the actual multiple in accounting for the inefficiencies? Like, how much time did I have to spend, to your point, how much time did I have to spend tracking down the title work or the financing documentation? How much time did it cost us on top of, you see, because the way my mind works, and maybe I'm completely crazy, but I think like, okay, yeah, it cost him $40,000 a year to have Mike as an employee, but if Mike isn't running at optimal efficiency, he's actually costing me more than $40,000 a year, because he could have been able to produce much more for that same price.
Well, as a matter of fact, many times during close periods, we're trying to close a month.
Yeah.
They're incurring overtime. So Mike may not, his base salary may be 40,000, but you may be paying him overtime. And a lot of it is because of these inefficiencies, as a matter of fact. And not only that, I'll take this a step further. You have to basically, a well-run, and it doesn't matter the industry really. It could be dealerships, and it can be any kind of company. You basically don't want to have your accounting department be merely a data entry function. You want to, have, it should be 20 or 30% data entry, or, let's call it compliance and number crunching. But the other 70 or 80% should really be analysis and providing you with, a picture of where you stand. What is your cash flow every day? Are you able to know that with precision? Or do you know what your profitability is per vehicle, to the extent that okay, if I, wouldn't it be better if Mike spent his time looking at, okay, what is my cost on a deal? How much is is coming in through rebates, and what is my true gross profit? And using and taking even a step further, leveraging some of the other technologies that are out there, and spending time on fine-tuning reporting from add-on tools such as Accessa is one of them. There are many out there that are add-ons. If you turn your back office more from a data entry, number crunching, to analysis, and that would be a better use of that $40,000 or $50,000 salary.
Interesting. And I love this. This speaks to my analytical brain, because I'm a to the penny kind of guy. Like, I hate, maybe hate's the wrong word, but I loathe, and I'm just going for equally horrible words, but I can't stand when somebody's like, if I go, hey, well, what did that cost? And they go, oh, well, it was like $500. No. Was it actually 500.00? Or was it 497.23? Or was it actually 600? Or like, don't sugarcoat it. Like, give me the actual number, because it's in those pennies. I think so often we write off the pennies, the nickels, the dimes, not realizing that we've probably spent, and then all of a sudden we're like, wait, how come we're $100,000, $200,000, $300,000, $500,000 over budget?
Well, that's exactly right. And that leads me to another point, which is a lot of the, relatedly, if you have the right reporting, you can analyze your expenses. I always recommend that dealership owners analyze their expenses on a 12-month rolling basis, so they could see where they may be deviating from their expectation, whether it's through a budget or just knowledge of, hey, why am I spending so much now on uniforms, or why did my computer expense go up? Why did my advertising go up? What happened? Did we place another ad I was not aware of? All kinds of things that basically you could see by spending your time looking at the numbers. But if your accounting department is busy, your office manager or controller, all they're doing is deal processing and spitting out a dealer statement that's sent to the manufacturer, you're really doing a disservice to yourself if you don't have that additional data.
Sure.
So, and the best run dealerships are the ones that know their numbers. Just like it's just as important to know what's in your lot, what vehicles are in your lot, especially with used cars. What is in your lot, know your cars, know your inventory. It's just as important to know your numbers and know what's driving your profitability. And it goes from analyzing your revenue, understanding really, are you leaving money on the table on used car deals? Are you wholesaling too many vehicles, for example, that maybe you should be retailing instead? And unless you partner with your back office to really provide you some of that analysis, it's you may know it intuitively, but wouldn't it be better if you can see the hard numbers as to how profitable you really are on a per deal basis?
It reminds me of that TV show. Okay, so now I'm confessing a guilty pleasure. Chef Gordon Ramsay, Kitchen Nightmares. It's the show, the premise of which is where he goes into these struggling restaurants and turns them around, gives them a new menu, updates the look, shows them some marketing. But the first thing he always looks at is their numbers. Like, what are you actually doing here? Output versus in. And actually one of the things that you had mentioned right out of the gates here, which I want to dig into because I think it feeds into this whole analytical piece of the puzzle, you had mentioned fraud, risk of fraud from employees. What are you seeing out there? What are some typical ways that because having more of an analysis versus data entry back office, you're able to catch employee fraud, and maybe an example of something that's pretty common?
Well, that's a very good question. So employee fraud happens because, you accountants have something called the fraud triangle. There's the opportunity, there's the desire or the rationalization by the employee.
Right.
And there's something of value. So those aspects lead to the temptation for somebody that maybe otherwise be there's a pressure, right? An opportunity and a pressure may lead them to try to steal. So we see all kinds of, cases where cash, because the bank accounts are not reconciled. The key factor is somebody the key risk is having one person that has too much control overall over the entire payment process, for example, or the cash receipts process. So if, for example, you have an office manager that reconciles the cash, signs the checks, okay, can post journal entries and transactions that can basically help mask, theft, then that's a recipe for disaster. And then looking at the technology side of this, again, the old-fashioned controls are making sure that, and a lot of the technology and that the systems allow you to have all these things reconciled through the system, bank reconciliations and reconciling your floor plan balance to see, okay, if your inventory, is tying out, have you paid off all your floor plan when due? Meaning when you've sold the vehicle within 10 or 15 days or less. All these things are basically processes that have to be put into place, and the systems now allow it. And you could control a lot of it through insisting that accounts and transactions are reconciled and that people look at their schedules, and by having segregation of duties. So what does that mean? It means that in this example, you don't have the office manager sign checks. Maybe you should be signing the checks, or the general manager. And the office manager does not prepare the bank reconciliation. Another employee does. There's a lot of technology can also be a double-edged sword. And what I mean is, you have to also look at, it gets complex because you also have to look at who has access inside the system to do what. So if you have, for example, an accounting, a payable clerk, and they can have access to print checks, they get the checks back when they're signed by you, for example, and they can add vendors in the system. Well, guess what? They can create a fictitious vendor. To your point of something that I've seen, create a fictitious vendor or modify an existing vendor just to change the name a little bit, print it out, and have a fake check and pilfer from you without you really even realizing. Especially if you also have a combination of factors where your bank accounts are not being reconciled. So that's a huge risk. But there are risks throughout the dealership. The parts department. These parts basically are subject to theft all the time. Very easy. You can't tell you how many times I walk, and a lot of it's common sense. I walk, in the back of a dealership, and the door is wide open, the back door, and there may be valuable parts in the back office.
Yeah.
So, or in the back in the parts department. So, basically, a lot of it is common sense. It's reconciling. It's monitoring what's happening at your store. It's segregating duties and knowing who can have access to what inside your systems. You also see cases where you could be a salesman that maybe, if for a high-end dealership, maybe steals a customer list. Basically now has all these contacts, takes them with them to a competing dealership. Of course, there are legal ways to protect yourself with non-competes and so forth. But still, there are so many risks out there that you have to be monitoring. But you can use technology to help you. Aside from implementing the old-fashioned controls of segregating duties so that not just one person does everything, that regarding cash, you can also use exception reports. For example, Reynolds has exception reports, Reynolds, that it's called suspicious activity monitoring, as an example. And that reporting will tell you if some transaction looks out of the ordinary, whether it's an expense or disbursement, and all kinds of other areas of your dealership. So there is a lot. This is a topic that you could probably do a whole podcast on all the different on all the different ways that, unfortunately, dealerships that are at risk from the inside, let alone from the outside, risks as well.
Okay, so here's another real issue, and I mean it's sad that this stuff is going on, but I love what you're saying, that it is highly preventable if you just started paying attention. So I guess first of my next round of questions would be, what percentage, from your experience now doing this for your career, what percentage of dealers are not doing these things? Like, how do you get, I guess where my mind is at, Juan, is how do you stay in business and not pay attention to your money? And so I guess the question is, from your vantage point, how many dealers do you see that are actually not paying attention to this degree, or to the degree that they ought to?
Well, no one dealership group, and we have some clients that are excellent in their controls, but you can always improve. I always would look at it from the point of view of you can never be complacent. I see that there are many dealership groups that don't take advantage of picking the brains of their advisors, and also Group 20, meetings, and really knowing what those risks are. So if you don't belong to one of these Group 20 groups that basically where these issues are discussed, you're probably missing out. I would say that there's a good deal of dealerships. 20% of the dealerships out there probably are not paying attention, would be my guess.
Okay.
Especially the single store dealerships, because they have a lot going on. And frankly, they don't necessarily have the resources. It's expensive to hire somebody else, but that's why, to segregate those duties, a lot of people might say, based on my commentary, well, I only have an office manager and 2 clerks because I have a single point store. I cannot afford to hire another person. Well, all the more reason to leverage technology so it provides you some of that exception reporting. And also, you can still think outside the box to leverage the resources you're not thinking about. For example, you can have your receptionist, for example, be the one that adds the vendors in the system, okay? Or that mails out the checks, so that the office manager, for example, doesn't have access to those functions. So sometimes it takes a thinking, outside the box, and you can still accomplish a lot with the resources and your capability that you have with your current employee force. A lot of it is just basically organizing it and organizing your employees in such a way that, or a couple of people, because that could be risky. What's more, even if the person is very honest, and we're talking now in a period of time where there's the virus outbreak out there with the coronavirus concerns, anytime, at any point in time, it's always a good practice to have critical tasks cross-trained. You don't want to have just one person that knows how to do payroll. That would, because that one person, God forbid, gets sick, who runs your payroll? You don't want to have just one person that can, process payments. You want to have cross-training. But again, how do you do it so that you don't have, incompatible, functions? So one person handling things that, they shouldn't be handling if they're handling something else. So all that takes a lot of thought process.
Yeah.
But it's critical because, investing in training and investing in organizing your back office is critical to your success. It's critical.
You brought up something that I want to dig into, and then of course I have to. We've got to dig into taxes. I mean, it's just that this is how we roll. But you had mentioned the importance of thinking out of the box, of having all of these processes. You also mentioned that and I get this. I mean, we all get this. It is expensive to hire someone else and then go through all the training and onboarding and all these sorts of things. However, I've gone through an experience in my business where you think you've got an accountant or a bookkeeper that's just doing a great job. And then in my case, I moved, and we moved the company headquarters, and we had to find another accountant. And of course, that accountant goes, "Well, what were they doing here? This doesn't make any sense why they were doing it this way." And then you find out that they're maybe not really that great, and you get somebody else's opinion, and they go, "Well, what were they doing? I don't understand." So I guess what I'm getting at is everybody thinks that they're probably the best accountant or bookkeeper, and you know what, mazel tov, good for you that you're confident. Or the dealer might think, "Nah, I'm good. I've got the right person." Or no, maybe I'm suspicious that I don't have the right person doing some of these basic functions, or that's maybe not analytical enough, or these sorts of things. What would you recommend they look for, or what questions can they ask in order to vet an accountant or a firm to work with them?
Well, the most important thing is what experience if you're betting, and let's start with an accounting firm, what experience do they have have they been auditing dealerships for a long time? Because dealerships on the surface may look, oh, it's just a retail business, but there's a lot of knowledge that you must have to really understand the industry. It's a very complex industry, more than meets the eye. So that's the first thing: years of experience, reputation, in which you'll know from talking to other dealerships. What is the reputation of this accounting firm? How long have they been around? Do they provide good service? And the other thing is, you want to leverage whoever your professional is. You want to leverage their knowledge and basically serve as your right-hand person in, knowing whether your internal accounting department is functioning correctly. So because we see a lot of different dealerships, we have a lot of the known best practices as to what you could be doing better without giving, we could tell one dealership without giving away anything proprietary. After all, these are mostly back office, transactions and so forth. We'd say, you probably should consider doing it this way. And having that depth of knowledge operationally of how to best operate and how to best react to different situations is what you're really paying for in an accounting firm. Anybody can prepare your tax return. Anybody can perhaps help you with some bookkeeping, but there's a difference between that and really knowing the industry deeply and knowing it from the inside out.
Sure.
So there's a lot of difference with that. But as far as hiring somebody internally, the experience matters. And you also, want to make sure that it's somebody that's worked for a large or respectable group that has, a good history. A lot of times also, your group 20 members will give you tips as to, and referrals. The best people that you hire are referrals. So a lot of them may say, hey, I know such and such, that is at this group. Maybe they're an up-and-comer. Maybe they're an office manager moving to a controller role, and maybe you want to tap on them and reach out to them. So those are some of my advice as far as hiring somebody internally. Just maybe network to, like you would to hire an F&I manager, for example.
Sure.
Use your network to find the right candidates.
Love it. All right. We knew we had to arrive at taxes. our favorite topic of discussion in the business world. What's maybe something you can share to wet our whistle about something creative, maybe something that dealers aren't doing that they could be doing, or something that they could be leveraging in order to do something creative with their taxes? I mean, maybe it's alleviating the tax burden, maybe it's reinvesting, maybe it's, do you know what I mean? What's something that you typically look for that you could encourage those listening to do when it comes to tax?
Well, one thing now that we have the situation with the as I was thinking about our discussion today, one of the things that came to mind that changed with the tax law changes that occurred in 2017 is that there was a credit created for paid family leave and medical leave. So it provides a tax credit equal to 12.5 to 25% of the wages paid to certain employees. And there's some restrictions around it and some rules to follow. But if you have to have somebody on medical leave and you have a program for medical leave, to not forget to look into, ask your tax advisor about using that tax credit if you're providing leave for people that maybe become ill as a result. God willing, the virus will be contained as we speak. But either way, it's something that it's a good benefit for your employees if you're able to provide them a couple weeks a year in case they get sick. So that's something to keep in mind. Now, on the more mundane, run-of-the-mill stuff, obviously there is Lifo that, it's one of the old standbys for dealerships to have your new vehicle inventory on Lifo. That saves taxes over time. Why? Because the inventory is costed higher for cost of sales purposes, lower on your balance sheet, and therefore it creates a tax savings. Higher expense, higher cost of sales creates a further tax deduction. Now, some of the more creative, those are more run-of-the-mill things. The more creative things that are out there that not all dealerships, this is, when you ask me a question of what percentage, I think a lot of dealerships forget to do this, is cost segregation. So cost segregation studies. So if you have, and the manufacturers more and more are getting very demanding about requiring dealerships to facelift their facilities. So if you're one of those dealerships that has to go through one of these makeovers, or it's just time that you did one, consider that, having a professional do a cost segregation study, because that way the life of the assets gets segregated. That's what that's what that means. So for example, you have a building with lights, and other fixtures. Maybe the lights are depreciated faster than the building, the concrete walls themselves. So if you depreciate faster, you get a tax, a bigger tax write-off, right? So those kind of things have to be kept in mind. If you're going to be doing a build out, you should talk to one of your first phone calls, aside from calling your architect and contractor should also be to contact your tax professional and ask them about a cost segregation study. So that's always important to keep in mind. The other thing to keep in mind, and it's sort of related to it, is if you are doing a lot of additions, okay, to your assets, is bonus depreciation. Now, interestingly, with the new law, there's a limitation on how much interest income you can deduct. It's up to 30% of the taxable income. But dealerships are able to carve out a additional exemption for floor plan interest, you know, the amount that you pay for financing all your vehicles, right? And it's basically dealerships can expense all of their interest expense, basically. That's floor plan related, but it came at a cost. It basically means that if you are tapping into that 100% floor plan interest, in other words, if your total interest expense for, let's say, a mortgage plus your floor plan interest exceeds 30%, and you have to avail yourself of the other, benefit for dealerships of deducting, you elect to deduct all your floor plan interest, then you can't have, bonus depreciation. You basically are limited on your bonus depreciation. So that's something that has to be monitored. You know, for example, going back to the example of a facility, if you are maybe rebuilding a facility and you're doing it in stages, and maybe you can, with right planning, you can maybe do it in stages, because the prohibition on bonus depreciations only applies to assets placed in service during a year when the dealership needs to take the floor plan interest exclusion into account. In other words, if you basically say, I'm going to build the service department first, and then I'm going to do the facelift on the showroom, you may be able to have your cake and eat it too. Why? Because you're able to time it so that you don't meet that threshold with the floor plan interest. Some dealerships will, that are very large will still may hit it. It all depends, and the numbers would have to be looked at, but it's something to keep in mind as you're planning, and it interplays with the cost segregation studies.
Wow. I mean, so ultimately what I'm getting is whether you're located in the United States, Canada, the Philippines, like wherever, it's important that you have somebody on your side, your tax advisor, that actually understands your business operation so that you can consult with them on ways to get creative, to take advantage of the rules. It always boggles my mind, especially people that don't understand business, or maybe some people that are in business and have not fully gotten there, that they think they're taking advantage, like they think that they're cheating, or it's like, no, dude, these are the rules. I didn't write the rules, but you're a fool if you don't play by them. Like,
absolutely. I mean, the tax law, is written in a way that it's written by Congress. So it's basically people writing these rules. They're not mathematical rules, or they're just basically many times written by legislators that want to drive a certain behavior, and there's constituencies, right? So the NADA, the National Automobile Dealers Association, is basically was advocating for these exemptions, so that we would not have dealerships that would lose their deduction on interest, floor plan interest expense, because that really would have been adverse to dealerships.
Sure.
But you want to be aware and work with somebody that is going to basically be your partner in not only knowing the operations, but also you want to understand how do you take advantage of and plan. There's nothing wrong with avoiding taxes by planning. There's nothing wrong with that. That's perfectly fine, and not only legal, but as a proud American, you should be able to say, well, I'm basically following the law. I'm not doing anything illegal here. Right. I'm basically, ensuring that, I take advantage of planning. And that brings me to another topic, lastly, for dealers to keep in mind, is succession planning. So it's a good time to look at, if you're, a dealer that is basically getting ready to retire, wants to pass the dealership on to his children, then you want to look and have a good estate plan for passing on. I mean, the new law, it went from $5.5 million, the exemption for the estate tax, to approximately $11 million. but there's some planning that needs to be done, especially for larger groups. And that's something that is also important to keep on your radar as well.
I love this conversation. Juan Pena, thank you so much for joining me on the Dealer Playbook. How can those listening get in touch with you and learn more about MBAF?
Well, our website is M as in Mary, B as in boy, A as in apple, F as in Frank, MBAFCPA.com, MBAFCPA.com. And my email is jpena, P-E-N-A, at MBAFCPA.com. And my number, feel free to either reach me by email or call, is 305-377-9212. And we have a website with our professionals. And also I would encourage you to read our newsletter. It's called Driving Profits, that is online at our website as well. And in case you're so interested, I'm on LinkedIn as well.